Are you thinking of buying a home but don't really know what you need as far as a loan? Well, we're going to talk about loan types right after this. Rhonda with Comey and Shepherd Realtors, and I know there's so many things to know when you are first getting started looking for a home. And so we're going to try to break down these loan types so that you can know what to ask for, or at least what you're getting into when a lender starts talking to you about the different options. All right, so first off, the thing that most people are aware of is conventional. It's always been 20% down. However, that still can be done with lower amounts down. So you can do 10%. You can do usually 5%. There is also a 3% option, which is a home ready loan for more first-time buyers. And then sometimes I've even seen a 1% down. I'm not sure if those are still in existence, but I have seen it in the past, so something to ask about. The 3% home ready loan does require that you take like a little class. It costs a little money to take the class, but for those people who are trying to buy a home that's maybe a little bit older and the sellers wouldn't want to go FHA or another loan type, then that 3% conventional can come in handy. All right, and the reason that people love conventional is because it's a pretty smooth and easy process. It starts to get a little more challenging when you move into some of the other loan types. So the first one is FHA. It is insured by the Federal Housing Authority, Administration, whatever that A is. It is 3.5% down, though you can always put more down. And you do have something called private mortgage insurance on any loan that is less than 20% down, typically. So FHA does have private mortgage insurance, which is like an additional amount on your loan every month in perpetuity. So for forever and ever until the loan is closed, refinanced, whatever. There is not an option for removing that private mortgage insurance even once you have 20% equity in the home. So that's just something to keep in mind. However, because it is federally insured, that private mortgage insurance is a little bit less. We also have USDA loans, which are also federally insured. And USDA, that sounds like food, right? So it is usually more in agricultural areas that they are trying to develop. They are 0% down and do have a little higher closing costs. That has to go to what they call rural development to be approved, which takes just a few extra days. Generally speaking, you can still get a USDA loan closed in 30 to 35 days. If you want a zero money down loan, that is always a good option if you can move into an area with that loan opportunity. We also have VA loans, which are through the Veterans Administration. And these are for, obviously, veterans. Now, VA has always had the most amazing rates. I do not believe there's any PMI on these loans, but there is a funding fee. And unless you are disabled, you are probably required to pay a funding fee. And this funding fee can be pretty hefty. In a lot of cases this past year, we saw many of our solid buyers who would normally be VA, they ended up going conventional if they actually had money to put down. Because VA is also a zero money down loan. They usually put that funding fee and other closing costs kind of on top. So you do have to look at overall the life of the loan because you're gonna pay more in total. Does that make any sense? So a little confusing, but again, hopefully this is just kind of getting you thinking about what it is that you're gonna want to do. So any of these federally insured loans, so the FHA, USDA, and VA, those all have stricter appraisals that have to be done on those properties. So many times sellers, they just are like, nope, not going FHA. I don't care. I don't care what the offer is. I'm just not going through it, because they already know that their house may have some issues that they just don't want to have put under a magnifying glass. It always, if we can put somebody in a loan type that will make it easier for them to get the house and it makes sense for their financial situation, we're going to go whatever that route is, because those, just knowing that the appraisal is a little more challenging, like I said, being in that FHA, VA, or USDA category puts you at the bottom of the pile many times in a multiple offer situation. There are more loan types. There are doctor loans, there are portfolio loans, but there's even more. Did you know that you can get a rehab loan? So if you find a property that is not in great shape and maybe it wouldn't pass FHA appraisal, like say there's drywall missing or plaster missing because there's a roof leak, that is not going to go through FHA. And anything that's a big trip hazard, safety hazard, utilities don't work, or something like that, those things are not going to get through that FHA appraisal. So you can do a 203K loan, which is through FHA. They're hard, they're time consuming, but it can be done. And if you have good credit, I personally would recommend a hard money loan. We have several folks here in the area that can do hard money loans, and that loan is based on you being able to pay the money back, but also based on the property. All right, so what questions do you guys have? Certainly, this is not the end. This is just the beginning of the loan type discussion, but hopefully I at least got you thinking about what you would be looking for, or what questions maybe you can ask a lender when you start having those discussions. All right, thanks so much for watching, and make sure that you let us know what questions you have down in the comments. Also, like, share, and subscribe if this video is something that you want to see more of. All right, we will see you next time.